Hi, good morning and greetings from the mountain path, the world of finance. This is Ravichandran. This is part two of the lecture series on DCF valuation. So this is a path towards the free cash flow valuation of a firm. So this session will discuss the basics of the three financial statements, namely income statement, balance sheet, and the cash flow statements, and how these three statements are linked. So how we can use these three statements to get inputs for estimation of a free cash flow. So let's quickly go into the basics of an income statement and what are the inputs that we are going to assume. So we're going to assume some 45% of the sales revenue as the cost of goods sold, sales and general expenditure as 15% of the revenue, 8% of net profit as dividends, corporate tax as 25%, depreciation as 10% of the PPE. So let's quickly go into the sales revenue at 16 lakhs, less 45% of the sales revenue as COGS, and gross profit at sales revenue minus the COGS, less 15% of the revenue as SGA, less the fixed in cost, and as we'll assume this as a 1 lakh. We have earnings before interest and tax and amortization. EBITDA is 5,40,000. Less depreciation. So this will come, we can initially assume, or this will be nothing but the difference in the accumulated depreciation that is there in the last 2 years of balance sheet. So and then we'll use or calculate operating profit. Less interest. Again, this interest initially we can assume, but it is nothing but the weighted interest of the interest of the short-term loan plus interest of the long-term loan of the current year balance. Then you have the earnings before tax less 25% tax. Then you have net profit or earnings after tax. So you have 8% dividend paid to the shareholders. Now we have the reserves going to retained earnings. So this is the structure of an income statement. And again, when you are creating, so initially we'll assume some arbitrary amount for depreciation and interest. Then later, when you put the depreciation, this will come from the your balance sheet as a difference of the accumulated depreciation. This interest will come from the balance sheet of the current year principal outstanding, the loan outstanding, and for the short term or the long term. I'll quickly go into the balance sheet. We need 2 years of balance sheet, and 2023 will assume as the previous year, 2024 as a current year. So we'll start with the cash. So we'll assume with the current assets consisting of just three components here, and cash equivalent, inventory, and accounts receivable. So initially we can assume for the first year, for the second year, and also the inventory and accounts receivable slight increase, and for the cash and for this year we'll have to wait. We initially put some arbitrary amount, so this will be linked to the cash flow statements, the net cash that is from the cash flow statements, and added with the previous cash. Now we go into the current assets. Again, we'll just take only one item, gross PPE minus the accumulated depreciation. The accumulated depreciation will take 10% of the PPE as an assumption. So we'll use a net PPE. So the total assets nothing but the long-term assets, which is net PPE, that is nothing but gross PPE less depreciation. So the total assets is the total current assets value plus the total assets. Now go into the current liabilities. So the current liabilities is accounts payable, accrued interest, and the short-term loan at 10%. So we'll take some arbitrary value here, and similarly for these 2 years. So we'll have the total of the total current liability. For the non-current liabilities, we'll take a long-term loan at 8%, equity. So again, we'll assume these values, and mostly you can. So this reserves for the last year we assume, this year and the current year, the last year reserves plus the retained earnings, and that comes from the income statement. So this is a very important linkage here. Now we have the total non-current liabilities. So your complete liabilities is current liabilities plus non-current liabilities, which is tallying right now. So now you can see the net income. Okay, and this is coming from your income statement. Again, the depreciation either can come from your difference in accumulated depreciation or from the income statement. Then the third important item is adjustment to working capital changes. So here we need that is one of the reasons we require 2 years of balance sheet. So we require change in the current assets, which is deducted, That is, increase in the current assets is deducted, increase in the accounts receivable is deducted. So these two are the current assets right now. Similarly, the increase in current liability is added here. So that is a general rule. We have only two items in current liability, which shows a marginal increase for the, between the 2 years. Now we have the net cash flow from operation is 3,78,750. So, so three broad items in cash flow from operation using indirect method: net income, depreciation, then we have adjustment to working capital changes. So cash flow from investing consisting of the increase in the investment in the PPE in this particular example. So we have 12 lakhs minus 8 lakhs is 4 lakhs. So that is a investment that goes out as a negative. So other item that can be included in cash flow investing, again sale of any long-term assets, again investment in securities and in sale of investment securities, etc., and acquisition of a firm. All these things will come into the investing. So cash flow from financing, we have and loans, long-term loans, additional increase, that is increase is 1 lakh. Short-term loan increase is 30,000. Increase in equity capital is 1,15,000. We have a less dividend. So these items sum it up, you get 2 lakh something. Now you get the net cash flow, and you add cash flow from operation, cash flow from investing, and cash flow from financing. You get 1,96,000. The previous year's cash was 50,000. Now your cash at the end of the year is 2,46,000. This should come in the top of your current assets here. That's the linkage here. So now we can see that and everything is linked here. So you should understand this income statement, balance sheet, and cash flow statement, how things are linked here. Now, number one here, you have the depreciation actually comes from the difference in accumulated difference. And the interest comes from the two loans, short-term and long-term, and the respective interest rate. Now, then other thing that means that your dividend is an assumption. Now your reserves will be taken to, and this reserves here it is added to your what is called your non-current liability, the reserves of last year, and plus the retained earnings that will go here. So that is an important linkage here. Now, other than this, what all the cash flow from statement, your net income comes from income statement, depreciation comes from balance sheet difference and accumulated depreciation. And then you have the inventory, that is nothing but adjustment to working capital comes from the increase in current assets deducted, like inventory and liabilities. We have discussed that. So you have net cash flow from operations. So you have net cash flow investing is only one item here in this example, and that is nothing but the increase of the PPE here. Okay, that is gross PPE. That's the only thing. Now you have five items in a cash flow from financing. Again, this is the linkage from your balance sheet, increase in the long-term loans, and again you have increase in the short-term loans. Then you have equity finance actually, and you have an increase. Then you have a dividend that is paid. So you have cash flow from financing. You need to and totally it up. You're not. So your cash, net cash plus last year cash flow. So understanding the income statement, balance sheet, and the linkage is very critical before we start discussing the next session on how to estimate what is free cash flow to form valuation and how to get the inputs for calculating FCFF using different formulas. So thank you for watching. Thank you.